following program is sponsored by Adams Financial Concepts. Welcome to About Money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth and has a proven track record of managing long-term investments, surpassing the markets in the long term. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
And it is Saturday. We are going to be talking about money, and with the coronavirus, COVID-19 going around, there's a lot to talk about. The market is down. What's happening in the market? What's going on? How should you react, and why should you react? So you know that I say oftentimes that history doesn't repeat, but that it rhymes. I think there's history that we can look to and learn lessons from. And maybe the best place to look is October 19th, 1987, Black Monday. The market had already started to go down on Wednesday of that week. It had almost been at 2,500, a tenth of what the market was when our market started going down this most recent time. But it was almost 2,500. It began to go down on Wednesday. It went down a record amount. It went down 58 points. Think about that. The market last week went down 2,900. It went down 58, and that was a record day. And then the next day it went down 108, and that was a record day. That was on Thursday. And then Friday, it went down again. All that leading up to October 19th, 1987. It was Black Monday. The market, in equivalent terms, was 1/10 of what it was today. But when it dropped on that Monday, it dropped 508 points. That would be as if the market today dropped 5,000 points. And we got close, 2,997 on the 16th on Monday. But that's where it was. Now, I was fairly new in the business. I licensed in June of 1986. So 1987 came as a huge surprise to me. Maybe many of you are taking what is going on now as a huge surprise. But back in those days, I started out as a stockbroker. I was cold calling. I was building stock positions. I would sell stocks. I would buy stocks. And I was talking to clients all the time, all day long, from early morning until late afternoon, sometimes even into the evenings. I was cold calling and soliciting, asking, because in those days, that was before you did fee-based accounts. The way you made money was every time you sold or every time you bought, you got paid a commission. It was a transaction type business. If you didn't do any transactions, you didn't make any income. So in those days, we didn't have desktop computers. Back in those days, we had a Quotron machine that had all the quotes on it. And as I came in that Monday, before I could start making my calls, already the market had been down on Friday, and it continued straight down. It went down 100 points, almost in the first half hour. And then it began to level off a little bit, but it continued down. It went down another 50 points in the next hour. And then in the next half hour, well, actually it started to rise a little bit, and then it started to drop. And in the next half hour, it took a sharper drop down 110 points. In today's terms, that'd be 1,100 that it dropped in the next half hour. And I'm sitting there watching my Quotron machine. In all rights, I should have been calling and trying to buy and sell stock. I was so amazed at what was going on and so much in shock. I just sat and stared at my Quotron, watching the sales take place. And I sat there for the first hour and a half. It was the equivalent of the market being down 2,000 points in today's market. And then we began to get a rally. And in 15 minutes, the market began to rise. And it rose about 40 points, about 400 points in today's market. So it began to look as if the market was correcting. The drop was over. And And then the market continued down. It may have recovered 40 points, but it dropped 80 points. And it just kept going down. In the next hour, it lost all of the gains. In the next hour, it continued down the rest of that day. The Dow hit the lows of the day at the end of the day. If you look back when we dropped 2,997 points on Monday the 16th, this last week, it was the same way. The market kept going down and it hit its low at that point. It was a day I sat and stared all the way through. I went, even during the lunchtime, I just sat and stared. Now, the market closes at 4 o'clock in the afternoon, New York time, which means 1 o'clock U.S. time. And usually we took lunch at 1 o'clock. I sat there in total absolute shock for over an hour, just wondering what in the world was going on. And as people began to talk about what had happened, what we began to see is the market got overwhelmed. So back in those days, computers were it was just the time of starting to use computers. People were writing computer programs. We call them algorithms today, but back in those days, they were beginning to write programs because volumes had increased and demand had increased to the point that programs were being written to buy and sell, taking advantage of index options and futures in the Chicago market and the stock prices in the New York Stock Exchange. Now, if you think about what we have going on, in New York, you have the stock market that's going on and you have the trades going on. In Chicago, you have the index options. And in those days, sometimes, and even today, you find that there's a difference, a small difference between what a stock is selling on the New York Stock Exchange, for example, and what it's selling for on the Chicago index. And so the computer programs were written to take advantage of that. And because the differences were so small, 1/4 of a point, 1/8 of a point, 1/16 of a point, the computer programs were written so that they had to trade a big basket of stocks to take advantage of those differences, which also meant it couldn't be one stock, it was a whole basket of stocks. When you did a trade, you might trade $25 million of 100 different stocks. Total, $25 million. And that's what they were doing. They'd written these programs, and the idea was to make money in little bits. Not a whole lot different from what is happening today with computerized trading. It's become a lot more sophisticated. Algorithms are now making the trades without any human intervention at all. But in 1987, it took a human being to look at the Chicago Board of Options and the New York Stock Exchange, and that human being had to press a button to buy and sell. And the programs had to execute simultaneously, so that you executed in Chicago and you executed in New York at the same time to take advantage of that disparity between the stock prices. And all of that was considered insurance. Actually, it was hedging, but it was arbitrage, but it was called insurance trading. It was unproven. Nobody had seen it happen a lot before. It was a brand new concept. Wall Street goes out and hires the most brilliant of brilliant people, and they write programs, they come up with sophisticated products, and that's probably going to be the way it is forever. They just come up, they write programs to take advantage of what's going on. But what happened on October 19th, 1987, as the market had gone down? It had been fairly controlled. Even though it was selling off on Wednesday, Thursday, Friday, it was fairly controlled. But on Monday, as the market took that steep plunge down 100 points in the first half hour, the equivalent, the market was beginning to be overpowered. And what you had is traders hitting the button to trade $25 million worth of stock. But because there were so many trades going on at that time, They couldn't see the executions that it actually got traded. So worried that they hadn't executed, the computers hadn't actually executed the trade. You had traders that were pushing the button again and again and again to make sure their trades got off, having not seen an execution at all. It was the first time we traded 1 billion shares in one day. The very first time. I had a client once, and I'll tell you that after we come to the break, about what he had to say. But it was unproven, and it was simply the markets being overpowered by all the trading that was going on. It was to have an impact. It was to have a huge impact. And it was to set the psychology. The market had the biggest plunge it's ever had. It went down 22% in one day. It was a shock. It was a tremendous shock. And that had psychological impact on what people thought about the economy, what people thought about the stock market. I'm going to talk about all those things when we come back after the commercial break. And I'm going to talk about how that applies in the last part of this program. So don't go away. We've got a lot of to talk about. I've been through 1987 through the 1990, through 2000, through 2008. I've been through all these times, and there's lessons to be learned and things to be done. Don't go away. We're coming to a commercial break. I'll be back after the commercial break. We'll talk about the impact of October 1987. We'll talk a little bit about how it applies to 2020. Don't go away. I'll be right back.
About Money with Mike Adams on AM 1590, The Answer. For more information, click on Adams Financial. About Money with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com.
So I've been talking about 1987. History doesn't rhyme, or history doesn't repeat, but it often rhymes. There are tremendous lessons to learn from 1987. I've been through this. I was through this in 2008. I was through this in the dot-com. I was through this in the recession of 90. Through this in 1987. There's lessons to be learned. There's a reason why you hire a person with experience to get you through these times, but that's a whole different subject. Coming back, 1987. The market plunged down 22% on that day. It had been coming down Wednesday, Thursday, and Friday beforehand, but on October 19th, 1987, 1 billion shares were traded in one single day. Today, that doesn't seem like very much, but at that time, it was overpowering. Executions were delayed. Executions were late. Nobody knew what was being executed, what wasn't being executed. I had a client who had been a stockbroker in 1929, and he described what happened. On October 26, 1929, he said the market was so completely overpowered by selling that in order to match the executions, back in those days, you wrote a ticket, it went by telegraph into New York, it was executed, New York or Chicago or San Francisco, onto those stock exchanges, and then you got a playback, and they would send back a telegram to say the trade got executed. They had so many trades taking place in 1929 that they rented in Seattle to match the paper up, the execution with the trade orders. They rented every hotel room in Seattle, and they laid out paper on every one of the hotel rooms, and one by one matched those. It took them 3 days to match the orders with the execution. He said to me, 1987 was like 1929. The markets were simply overpowered by the technology. People couldn't see if they got the executions when they pressed those buttons to do the trades. That was then. But the psychology before it was that stocks were overpriced. There was fear that the Fed was going to raise interest rates because Alan Greenspan had just been appointed to the head of the Fed. There were all sorts of psychological things. You had the trade deficit. You had the budget deficit. You had a concern that Social Security was going to run out of money. And that very morning, there was an American attack on an Iranian facility because an American ship had been attacked by an Iranian missile. All that took place. The market came crashing down, and the belief that stocks were overpriced because the market had gone from 700 to 3,000, or to almost 3,000, since 1979. There was that belief, similar to what we're doing today. There was a wholesaler that came into the office after the October 19th. There was a wholesaler that came in that week, and he said there was $1 trillion gone from the economy. $1 trillion had been wiped out by October 1987. We for sure headed for a recession. And he said, you'll be able to go into Nordstrom's this weekend and hear a pin drop. That's how bad things are going to be. I went home. I told my wife, we have to go to Nordstrom this weekend. This is what this guy said. We went to Nordstrom that weekend. We couldn't get into the store. It was so packed with people. I guess people, they didn't know that $1 trillion had been wiped out. But I began to count in those days, being a skeptical person that I was, I began to count the number of people that said the market was going to be up and there was going to be no recession, and those who said the market was going to be down and there was going to be a recession. And when my account got to 68 to 0, I quit counting. There was not one person who felt the market was going to be up. There was not one person that I heard, and of course they didn't have CNBC in those days, but it's the same. You had a lot of newspapers, you had magazines, you had newspapers, you had radio station. Everybody, all the talking heads, all the gurus were predicting how bad things were going to be. 68 to 0, I quit counting. But I'll tell you, at the end of the year, the market increased to a higher point than it was at the beginning of October 19th, 1987. And we did not have a recession. You know, when you hear people talking today about the impact of what we've gone through with the coronavirus, you got to think about that in terms of where we've been before. That's why it makes sense to listen to somebody like me. That's why I've prepared my clients for this. We're going through this, and why we're doing very well right now. That's the lead up. I want to introduce my guests. We're going to talk about the situation in the economy. We're going to talk about her business. We're going to talk about those things. And then I'm going to come back and talk about 2020 in specific, and what's going on and why it's going on and what you can expect. But that's coming up later, so don't go away. We've got that to come. But first I want to introduce my guest, Roz Edison of Marination. Welcome to the program, Roz.
Hi, thanks, Mike.
So Roz, let's start with your background, which is very, very interesting, by the way.
Thank you. Well, Mike, not many people grow up thinking that they want to run a taco truck, and I was certainly among those people. I'm Filipino and Chinese, and I was born in Athens, Greece, and I was very lucky to be adopted by an American family from the Midwest. And I spent most of my childhood growing up in Chicago. Eventually, my family moved to Idaho when I was in high school, and I went to the University of Idaho because it was really inexpensive in-state tuition. So I'm a fan of inexpensive in-state tuition back then. And that's when I got my first restaurant job, bussing tables and doing dishes in the summers and through the school year. And then right before I graduated college, I swore I'd never work in a restaurant again because it was such hard work. Yep. So the taco truck was definitely very far from me in my mind. And then I went after college into Peace Corps, and I served in Romania for 3 years. I had the great privilege of helping to start something that has gone global called Camp GLOW, Girls Leading Our World. Pretty neat program, girls leadership camps around the world in all the Peace Corps countries. And I returned to the States, but this time to Boston, and went to graduate school a couple times, once for business, once for education. And I had the privilege of working in the charter school movement there and starting a program there called Match Core, or helping to start it. I shouldn't take credit for starting it, but I was part of it. It's a pretty neat program, so anyone interested in public education should look it up. And then eventually I ended up in Seattle, Still not in the world of tacos or restaurants. Worked for NPower, a great nonprofit started by Microsoft, and the University of Washington as an academic advisor in construction management. So, and in that time, when we get to the end of construction management and UW, we had the recession of in 2008, 2009, and that's basically, and I was working part-time at the UW, and that's basically when Marination started.
So tell us about Marination. How did it start?
Well, during that time, a group of friends of mine, we got together to drink a little wine and talk about the market and enjoy each other's company. And that dinner party led to a conversation about this incredible food truck that was in existence in Los Angeles called Kogi. It was a Korean barbecue taco truck, and it sounded delicious, and we were just talking about how great it was, and wouldn't it be great if Seattle had something? And I've always loved spreadsheets. I've always loved data. I've always loved business in general. And so I started running some numbers and proposed to my friends after that dinner party that maybe we should try doing that. And they all thought that was not a great idea. But one friend of mine, Kamala Saxton, my business partner, and I, we thought it was a great idea. And we just said, well, heck, nothing else is going on in the market or in the economy, so why don't we take a little out of our savings and try this food truck thing? And here we are today.
So when you bought your food truck, the first one,
yeah. Mm-hmm.
So did you buy a new truck? How did you decide on what truck to buy, how to equip it, how to get started?
Well, it's a little bit akin to throwing a dart at a dartboard, but there are really three options when you start a food truck. You can either buy a brand new truck with a brand new kitchen, which is quite expensive. You can get a totally used truck with a totally used kitchen, which is incredibly affordable, anywhere from $10,000 to $15,000, but they're usually about 30 years old, and they've a hard life, typically on the streets of Los Angeles. And we took the middle ground. We didn't really know what we needed on it, but we got an old truck that had a new kitchen, and that seems to be a really cash-mindful way to kind of get up and running in a food truck.
And then, so you bought the truck, and then you started a route. Where did you go?
Well, we didn't have that many locations when we started. We had a couple, maybe two, and we just figured that once we got going, that people might hear about us, and we crossed our fingers and hoped that people would invite us to go places. And we were right. We were inspired at the time. Also, there was a truck here called Skillet, which is still in existence. They had a great model that we borrowed from. They would go to one location on a consistent basis on that day of the week. So every Monday they would be in the same place. Every Tuesday they'd be the same place. So we were looking for 5 locations. And in the heyday, we actually got the truck up and running to 6 different locations. We operated 6 days a week.
So, but you've moved beyond trucks now.
We have, because anyone who owns a food truck knows that, well, in business in general, as you have probably spoken on your show, there's an economy of scale. A truck is a rather small scale for a restaurant operation, and you need to get to scale to really not only get those economies and purchasing power, but also to also even out the sales. So trucks can be incredibly seasonal, and even though Seattleites are awesome and they will stand in the rain and the wind to get a taco, it is nice to be able to have 4 walls and a roof for them in the winter. So having a brick and mortar to offset the seasonality of a truck also makes good year-long cash flow.
That's great. We're going to come back and talk about that right after the commercial break, and we are coming to a commercial break. So anyway, you want to hear the rest of the story about Marination? It is one of the best places to visit. But hang on, we'll be right back.
About Money with Mike Adams on AM 1590, The Answer. For more information, click on Adams Financial Concepts. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So I'm here with Roz Edison of Marination. We just started to talk about the transition from the truck to the first restaurant. So tell us about that first restaurant.
Well, we started the truck in 2009, and about 8 months after that, we lost one of our key locations, which was in Capitol Hill. And we loved serving the Capitol Hill neighborhood and wanted to get back into it. And we heard about this teeny little 601 square foot space upstairs in the Harvard Market, the corner of Pike and Broadway. And we went to look at it and we thought, hey, this is perfect. It's about the same size as the truck. It's a little bit bigger, but it has all those walls and that roof that we talked about a moment ago. And it was it was a kind of fiscally conservative first step for us into the world of brick and mortars. And so that hence was born Marination Station, our very first brick and mortar restaurant.
But you went on to start a second one.
Absolutely. I was searching the internet and randomly came across an RFP from the city of Seattle, the Parks and Rec department. They had an RFP out for the Seacrest Boathouse concessionaire, and it turns out that was an awesome location over near Alki in West Seattle. And we applied for it and won the RFP, and we have been operating Marination Mackay over there ever since. That was about a year and a half after Marination Station opened.
So, I live very close to that, and it becomes a destination restaurant for a lot of people. They take the water taxi over, then take the water taxi to come eat at Marination, and then take the water taxi back to Seattle or rent a kayak or go skateboarding or rollerblading. It's become a destination place.
Absolutely, and we couldn't be happier about that. We've always, with a location like that, you kind of need to be a destination, but you also want to be. It's such a beautiful, beautiful view of our city, the water, to be outside. It's really fantastic, and we have an incredible privilege to be able to serve folks out there, both locals and all the visitors to our city.
And the food is very good. I have to say that.
Thank you. Thank you.
So you went on from there to open other restaurants.
We did. Well, we added one more Marination, which is downtown in one of the Amazon buildings at 6th and Virginia. And we also added a full-service restaurant called Super 6 down in Columbia City.
So talk about the menu. What if someone goes to Marination, whether it be in West Seattle or 6th and Virginia, or the Super 6 full service. Tell us about the menus.
Oh, sure. So the core of our menu is Hawaiian and Korean, which is what we started. We called ourselves, Hawaiian, Korean tacos and sliders. And that is fundamentally what Marination is about. We also have kimchi fried rice and kimchi quesadillas. Each of our Marination locations, though, has something a little bit different. So if you go out to the one on the water, you'll be able to enjoy fish and chips. If you go to the one downtown at 6th and Virginia, you'll get tater tots and some more sandwiches. If you go up to Capitol Hill, you'll have the famous torta sandwich. So it's really fun. And then down in Columbia City, we have poke. We have a much larger pastry program. We have things like pulehu ribs, which is a Hawaiian way of preparing ribs. Really, really delicious.
So in all those locations right now, with what's going on with the coronavirus, what are you seeing?
Unfortunately, we're not seeing nearly as many friendly faces as we used to, although everyone is friendly right now who comes by. We are, it's quiet out there, but I think everyone is doing their best to support all of their local restaurants, all of their favorites, and some restaurants they've never tried before, which I really appreciate. We were already set up as fast casuals in general to be a lot of takeout and delivery, but that is obviously now 100% of the business that we do, and so we have a much smaller team working for us, but we do have folks, which is great. I'm really happy we still have some of our team employed. And we just see people who come by. We see a lot of delivery drivers, so we don't know them. But the customers who call in and pick up their orders and head off, you can tell that they're appreciative to have a break from cooking and cleaning and just and are happy and proud to be able to support their restaurants that they'll enjoy. So there's a lot of community spirit out there for sure. That's what we're seeing mostly. Everyone's trying their best. We're trying our best, and customers are trying their best, and we're going to have to keep doing that for a while, I fear.
I think so, too. Sadly. So
yeah, this is a marathon.
Tell us again the locations of the restaurants. Give us phone numbers. Give us addresses so that people can write this down and so that they can.
For sure. I'm going to keep it easy for everybody. If you're listening to this, the best way to find us is going to be to go to our website at marinationmobile.com. and that will list all the restaurants, including Super Six, and their hours, and sort of what services of pickup and delivery they offer, and all their hours. So marinationmobile.com is the best way. We also have a really awesome and fun social presence, which I take zero credit for, but we have a brilliant person who manages it. And so if you follow us either on Instagram or Facebook or Twitter, you'll know where we are. You'll know where our truck is. Our truck is still rolling out, and I'll just remind everyone that food trucks in general, including us, we're 100% takeout. So a lot of us have online ordering or pre-ordering from the truck, so you can sit in your car, order your food, wait a few moments, walk up to the window of the truck, pick it up, and head home safely. So another option for everybody.
And in the future, when we're again back doing social events, you've been doing catering too. Will you continue that into the future?
Oh, absolutely. We had the slight misfortune of launching our brand new breakfast catering program right before the coronavirus hit. And so we have a phenomenal catering program that is both sort of delivery of food, but also our food truck can come to an event or help you sponsor, be with an event. So we have two options on that front, and it's really great. So we'll bring that back. That's actually still happening. There, folks are catering for first responders. They're sending meals to people, and we're helping sort of create a program right now to do that. So there's still catering that actually can happen now, even though you can't gather, but you could send it to a group of, say, nurses or, researchers who are hungry.
And it's a good way maybe people can donate to do that. Can they do that?
Yeah, they can actually. We will be probably posting something in the near future, probably in the next couple of days. About that.
So, well, thanks for being on the program. Thanks for Marination. It's right across the street from where I live, and so I like Marination.
That's great. Well, as soon as we can, we'll see you back there.
Okay. Thanks, Roz.
Thank you, Mike.
So I want to come back. I started the program talking about 1987, and there's application to what's going on in the markets today. 1987, 1990, 2000, 2008. There's a reason to look at history and see what's happening. So I want to take you back. I talked about October 19th, 1987, but I want to take you to October 20th, 1987, to really understand what's going on in the markets today. October 19th, 87, the market was flooded with orders, 1 billion shares traded. It was an incredible day. Those were the days in which normally you had 300,000 to 400,000 shares traded, maybe 200,000, maybe 150,000. No, not thousands. I should be saying millions, okay? And suddenly you had 1 billion shares that were traded. So when the market is coming down like that, the old rules don't apply. There's a saying that for every happy buyer, there's a happy seller. But in those days, when the market is crashing down like it did in October 19th, 1987, the only buyers are the market makers. And to understand what a market maker is, think about the New York Stock Exchange as it used to exist in 1987. What you had individuals who would pay up to $1 million to buy a seat on the New York Stock Exchange. And what that seat allowed them to do was to make a market in a stock, or on slower trading stocks, maybe it was 2 or 3, but take IBM, for example. If you owned a chair, and there might be even 2 people that made a market in IBM, but if you had a chair on the New York Stock Exchange, you paid for the chair, you had the right to make the book on IBM. When you had sellers coming in, you were matching sellers with buyers. And you see all the pictures of the people standing around with their hand signals, and you had 4 brokers, and you had all of that happening, but you had one person who's actually making the book and deciding what matching orders, matching buys, matching sells. But what happens if there's when things aren't in equilibrium, when you had more sellers than buyers? Then it was the market maker that had to buy the stock that was coming in. And what he would do, he would set the price at a low price where he felt he could buy the stock, and within a few days or a day or the next day, a week, he could mark the price up and sell it to people who were going to buy. That's what making a market was. Those people who bought the shares on this stock exchange, that's their business. That's what they did. They matched the orders, the buy and sell orders. If there was no stock available and you had buyers, it was the market maker who would short, and he would set the price higher for the buyer. So the buyer had to buy at the higher price, and the market maker would figure he could buy the stock at a lower price sometimes later. Sometimes he was right, sometimes wrong, but in the most times they were pretty right. That's the equivalent of the New York Stock Exchange. As NASDAQ came and computers began to trade stocks off the exchanges, off the New York, off the American, you had market makers who were just set up in local offices. That's what was going on. When the market came crashing down, it was the market makers who had to buy the stock. The implications of that? Right after the commercial break. Don't go away.
About Money with Mike Adams on AM 1590, The Answer. For more information, click on Adams Financial Concepts. About Money with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com.
So I've been talking about market makers. I give the illustration of the New York Stock Exchange, but as things developed and as computers came into trading, as NASDAQ came, NASDAQ, NASD now, as that began to flourish, what happened is you had people who could become market makers all over the country because they were tied in by computers. And their obligation to be a market maker is you have to have adequate credit that you could actually be a person who would make a market in the stock, actually what they said. But you had to be the buyer of last resort, you had to be the seller of last resort. So on October 19th, 1987, when the market came plunging down, billion shares traded, and most of those shares went to the market makers. They had to step up. So October 19th was Black Monday and a surprising thing. But what was worse was October 20th could have been disastrous Tuesday because the market makers had to come up with the money to pay for the stock that they'd bought on Black Monday. And in those days, you had a separation. You had the Glass-Steagall that separated brokers from banks. And the banks were the ones that loaned the monies to the brokers because the brokers had less capital than the banks. The banks loaned the money to the brokers to buy the stock, but the banks were not about to lend money to the brokerage firms. It could have brought the whole financial system caving down. Had the brokers not been able to buy the stock, had they not been able to pay for the stock that they bought, think of what that would have done to the financial system. It was Alan Greenspan that stepped into the abyss and said to the banks, you have to loan the $20 billion or $40 billion it's going to cost to cover the trades that happened on October the 19th. And that's what happened. Nobody remembers October 20th. I remember October 20th. I understand what happened. And what happens when you have a billion shares of stock sitting on the desk of market makers? They have to get rid of the stock. They have to pay off the loans they'd taken from the banks. And today, now with the banks owning brokerage firms, it's the banks that are sitting with a huge inventory of stock. When the market went down 2,997, there were 18 billion shares traded, 2.5 times the normal amount. 2.5 times the normal amount of stock that's traded. Where did they go? They went to the brokerage firms, to the arms of the banks. What are those stocks doing? The banks have paid those off. The banks have drawn money, and the Fed is loaning that money at zero interest for the banks to own that stock. But 2,997 going down, 18 billion was not the only day. There were a period of 5 days in which the volumes were 14 to 19 billion shares that were traded. Normally we trade 6 to 8 billion. So the extra stock is sitting in inventories. Now, market maker, what happens when you have the market plunging down? What happened on October 21st? On October 21st, the market went up a little bit. And as the market went up a little bit, it was the market makers who were selling their inventory to buyers on October 21st. And it was the market makers who were selling this stock to buyers on October 27th, on October 23rd, October 24th. It was the market makers who were getting rid of the stock. And so if you look at the stock, and I track it every day, I would look at the movements in the market. If you look at what happened on Wednesday, the market went down and then hit a bottom and started back up. Didn't finish up much because market makers were selling their stock. If you look at what happened on Thursday, the market started up, then it came down some, then it started back up, came down, went up, went. You get this pattern. The market raised a couple hundred points. The market makers are selling their stock to buyers. They're selling enough that it drives the price down. Market makers quit selling the stock. Stock dries up for sale. You have buyers coming in. They start to raise the market, and the market makers start selling the stock. So how does this wash out? How does this bottom wash out? To get past this time, you have to have about 80 billion shares of stock that trade. Think about that. The normal trading is 6 to 8 billion. We have to have 80 billion shares of stock traded. You know, there's a reason why those of us that have been around a long time understand these things. You listen to CNBC, you listen to the talking heads, the gurus. They'll tell you the economy's going to go bad. They're going to tell you that the market's going to go bad. They're going to give you all sorts of ideas, of all sorts of leads. A lot of them never went through 1987. They didn't go through 2000. We saw that with the dot-com. Same thing happened when the markets came plunging down. It was the market makers who had to get rid of their stock every time. When the market took a big dump, it was the market makers who bought the stock. And the next, you saw this kind of leveling out as the market makers got rid of their stock. You know, that's the advantage that somebody like I have. When I can look at the market, I can see what's happening. I've been through this in 87, in 90, in 2000, in 2008 and 9. It happened in 2008 and 2009. It was almost like clockwork. So what happens? So Edward Renshaw of the University of New York in Albany looked at markets from 1872 to 1990. There were 45 times when the market went down 5 to 40% since the Civil War, all that time since the Civil War. In 29 times, it happened during a recession or a depression, and 13 times it happened during economic times, good economic times. Think about 1987, 1989, or actually think about 2020. Either in good times or recession times or depression times, the recovery is very simple. You recover about 1/3 of what you dropped in the first 3 months once you reach a bottom. Then it can take up to 12 months or sometimes even more for the market to completely recover and go on. You know, in 1987, the market was down 37% from that Wednesday until it recovered. It recovered 37% in the first 3 months. And then, it recovered 23% in 12 months and 25% the second. 1990, 13% down, 29% in the first 12 months. So it takes about 90 days to know if you've hit a bottom. So there's a timing aspect with this. It's important to understand that fear sells, and you hear about compromising and things happening in the market and the coronavirus and the economy going down. You know, think about the market. The recovery, if we hit a bottom this past week, in 3 months, the market have recovered 1/3 of what it's lost. How do you tell if it's a bottom? well, you've got to know a lot more about what's going on. The question you have to ask yourself, if you're in 2022, what did you decide to do in 2020 that you wish you would not have done? There are going to be people that make big mistakes in 2020. There are right things to do and wrong things to do. I guess that's why you hire a professional money manager. That's what I do. That's what I do for my clients. That's why my clients don't call me during these times. Or they send in more money for me to invest. That wraps up today. I will be back again next Saturday, because if it's Saturday, we're going to be talking about money. Have a great week. This too will pass. Believe me, it will pass. Have a good week.
Listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you'd like Mike to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared in the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Saturday at noon for more About Money with Mike Adams, here on AM 1590. The Answer. The preceding program was sponsored by Adams Financial Concepts.